estate essentially is a business. So in any business, you have the ability to take the entire breadth of the tax code and utilize it. So you have the ability to take operating expenses against income, depreciation against income. You can have, various credits like solar tax credits that you can utilize in a business where.
Well, welcome everyone to the show today. It's all about tax strategies for real estate investors in 2024. An exciting show for you today. You're going to learn all about how to find a competent real estate focused CPA and tax advisors, which is crucial, especially when you're in real estate, because there's so many advantages of real estate. And we're going to learn about the latest tax regulations and what they mean for your real estate investing, because they're always changing, and some of those proven tax strategies and how you can leverage them, especially since we are in the real estate investing space, which is awesome. And then we're going to talk about how to be proactive around tax planning as well. So that's what things we're going to learn out today. And to help us with that is Tim Gertz. He's a CPA and partner of ProVision, and he specializes in tax strategies for entrepreneurs, professionals, and investors. And he specializes in real estate, and he's got 22 years of experience. And he does have experience in a wide variety of industries, but I do know he works with a lot of operators and syndicators in the multifamily space. And this is why he's on the show today. So with that, Tim, welcome to the show.
Thanks for having me.
So the first question I think I will have for you is, what are some of those advantages of investing in real estate versus maybe investing in other asset classes, stocks or precious metals or anything like that? Just give us a high-level overview of why real estate is so awesome from a tax perspective.
I mean, real estate essentially is a business. So in any business, you have the ability to take the entire breadth of the tax code and utilize it. So you have the ability to take operating expenses against income, depreciation against income. You can have, various credits like solar tax credits that you can utilize in a business, where starting after 2017, in investing in equities, bonds, stocks, precious metals, any of that, any expenses are non-deductible. So really the only thing you have working for you in those investments are the capital gains tax. And so you really just are shoehorned into that area. You don't have that ability to really play with the tax code, utilize the tax code to be able to take as many deductions and be as efficient as possible.
All right, so you mentioned something that maybe our listeners are watching aren't familiar with, like depreciation. What is that, and why does it matter?
Depreciation is essentially the IRS is giving us the ability to deduct the cost of an asset that we purchase over its useful life. There's been some changes up and down. Section 179 is one of the code sections that might allow you to write off an asset immediately. Bonus depreciation is another one. But really, depreciation is just giving us the ability, if you buy an asset, whether it's a chair or a refrigerator or a multifamily house or multifamily apartment building, to be able to write that off over its useful life.
So can you give us a little bit more of a practical example, right? So I don't know, rental property, multifamily doesn't really matter. You buy this thing and it, presumably you make a profit on it. And then all of a sudden, what happens to your taxable gain on that? It's like, give us a little example.
So let's just say we buy a single family house and we rent that out, and we are able to depreciate the cost of the building over 27 and a half years. So essentially, if we buy an asset, and let's say it's a $270,000 asset, and we deduct that, we're going to be able to take $10,000 of depreciation every single year, because 27 years over 270 is 10,000. So if we've got $10,000 of revenue on that apartment complex, single family house, then ultimately we're going to be able to offset that. So that's what it's giving us the ability to do, is essentially negate revenue using that asset to write off against that income.
Okay, so it's all a little bit abstract, because this depreciation is an expense against the business or the rental property, but it's not actually an expense. You're not actually writing a check. It's kind of like a paper expense, if you will. And so you have this 27 whatever and a half year write-off period that you have this phantom expense. You can use that to offset to your income on it, which is cool. Now, with larger commercial properties like apartment buildings, for example, there's this thing called cost segregation. and talk to us about what that is and, well, why that even matters.
So cost segregation is just allowing us to segregate the cost of that asset. So instead of looking at an asset like a multifamily and saying, well, this is just a piece of real property, which is depreciable over 27 and a half years, cost segregation study goes in and says, well, you've got refrigerators, you've got furniture and fixtures, you've got carpet, you've got land improvements, and essentially allows us to pull that asset apart and then depreciate each one of those assets over their predetermined class life. So instead of everything being 27 and a half years, now furniture and fixtures is 5 years, carpet is 5 years, land improvements is 15 years. So we're able to essentially speed up or accelerate that depreciation. And it also gives us the ability to use bonus depreciation, which bonus depreciation, depending on where we are in its life cycle, could have given us the opportunity to immediately expense assets. Where we are now at 60%. So we're allowed to depreciate 60% of that asset immediately.
All right. So what difference does that make? So go back to that rental property or small apartment building, right? So give us maybe an example of how that helps.
So let's say the apartment complex was $1 million asset and we don't do a cost segregation study. We're going to take and we're going to depreciate that $1 million asset over 27 and a half years. Let's say now we go in and we do a cost seg. And 30% of that asset is a 5-year asset. Well, that qualifies for bonus depreciation. So we can accelerate that 300,000 into this year. And then let's say the next 200 is 15-year assets, land improvements, pool, whatever it is, that also qualifies for bonus depreciation. So now we can pull that deduction in the current year. So what we're doing is we're essentially, maybe we don't need it, but we're hyper accelerating that deduction or that expense into the current year so that we can utilize it in future years when we need it. And that's where there's a huge benefit.
You have to pay it back though, right? If you sell.
It depends on when you sell. So there is depreciation recapture. That's the scary thing that everyone talks about is depreciation recapture. But you have to remember all these assets have useful lives. The IRS said a refrigerator has a 5-year useful life. If you hold on to that asset for 5 years, well, its useful life is 100% exhausted. So you don't have to recapture that depreciation. So now the gain on that is capital gains. So yes, there is depreciation recapture, but effectively, if you're able to use that to offset ordinary income in today's day at 37%, and you have to pay recapture 5 years from now, you utilize that money for 5 years. You've gotten the ability to reinvest to snowball that money. Yes, you might pay 37% in 5 years, but you've made money off of it in the current time.
So how do you keep from getting burned in that scenario?
I mean, one of the major things that you need to do, especially when you're selling an asset or you're working with someone that is selling an asset, is to get an idea of what that gain calculation is going to look like so that you can plan, be proactive around it. Because a lot of times what people do is, if it's a wholly owned asset, maybe we do a 1031 exchange. If bonus depreciation comes back into the fold, well, now we've just got to essentially buy an asset that will offset that depreciation recapture. And, and then maybe tax the rest as capital gains. So there's a lot of things we can do with it.
So building a pipeline is typically a way to get around that. So if you own 8 properties or you're invested as an LP in 8 properties and you sell one, the capital gains of that will roll into the others because everything is carried forward, right? So if you've already taken bonus depreciation on those other assets, you kind of have this like umbrella of guard against those capital gains. But as I understand it, it's not so useful for everyone in every capacity. Could you talk a little bit about the differences of statuses of investors and how this works for them?
I think it depends. So I would say it's useful for everyone. It's more relevant and useful for people that are real estate professionals, because what real estate professional designation does is it essentially takes the passive nature of real estate and converts it to an ordinary business. So now we've got ordinary losses that can offset other ordinary income, W-2 income, capital gains, retirement, all of that, where a passive loss can only offset passive income. But to that point, I would take all of those passive losses and I'd build, like you said, kind of a war chest. So now I've got this huge passive loss that carries forward indefinitely. It only goes away when I pass away. But anytime in the future that I have income that's passive in nature, well, guess what? That passive loss will offset it. And, on top of that, it also gives us the ability to kind of play with things, because depreciation recapture is essentially either ordinary income at your ordinary income rates, or could be capped at 25% if it's, real property. But then everything else above and beyond that is capital gains. And one of the nice things about passive losses is passive losses will offset ordinary passive losses before they'll offset ordinary passive capital gains. I know that's kind of confusing, but essentially we're able to wipe out all of the high tax rates before we even touch capital gains rates. So whether it's an ordinary loss or a passive loss, if we're utilizing it, it chops out all ordinary first and then goes to passive. So we've got this ability to play with it and utilize it to be as efficient as possible.
So all I know is that piece of real estate produces certain income, and because of the passive losses, it offsets the passive income from that. Therefore, you're not paying any taxes while you're holding the property, which is unbelievably cool. I mean, if I look at some of my K1s, there's some income on there, but there's a taxable loss, which then carries over to the next year and the next year. And that's pretty cool. Now, what I'm hearing you say, though, what Garrett's line of questioning is at the exit, you got to do some tax planning, because there is going to be, or there can be, a gain. And so this is why you have to work with a tax advisor on architecting those exits, such as in 1031 exchange or buying another property in the same tax year. And so I think that's really cool. There's also this thing. Let's talk about maybe the real estate professional status, because that's really cool. I think one of the cool things about real estate is this idea where I can have passive losses offset passive income. And that's cool. What if what if I keep carrying them forward? My passive income is much lower than my passive losses. But let's say I'm a high income earner. I'm a doctor, an attorney, and things of that nature. What is this real estate professional designation? Talk to us a little bit about that and how that might help.
Yeah, definitely. So in the tax code, real estate is inherently passive. It actually is carved out as being not a trade or business that is inherently passive. So real estate professional designation, all that does is that converts this inherently passive non-business into a business. And so in order to qualify for this, there's two things you really have to achieve. You have to spend more than 750 hours in real estate related activities. Very broad. They didn't typically define down what it needs to be. It's just real estate related activity. So it could be investment, management, resale, whatever that might be. And you have to spend more time doing that than any other income producing activity. The beauty of this is if you're a married couple, only one of you has to qualify for it. So if you are a high wage earner and your spouse is not, then you've got to kind of evaluate and look at, well, what's the trade or benefit? I've been in situations with clients where we're proactively planning and one makes $1 million a year and the other makes $100,000 a year, but they love real estate. Well, okay, great. You make $100,000 a year, but if I can take your real estate professional designation and offset $500,000 a year of tax or of income at 37%, or higher based on states, well, now you're making $250,000 a year. It's huge. It's a huge benefit. It's a huge boon.
Yeah, it's amazing. I actually have a friend who's a medical doctor, and they have started buying rental properties, and his wife stays at home with the 4 kids, and she just essentially self-manages them. And even if she's working, I don't know how many hours, 750 hours, not that much, but that's her primary source of quote income, is to manage rental properties. And now he's just shaved off hundreds of thousands of dollars of income tax. It's insane, right? And you can also do it with real estate brokerage, right? So the same way, it's just also real estate related.
Exactly. The only caveat to that is once you're a real estate professional, you have to materially participate in that business. So that's where the caveat where a lot of people get kind of caught up is, you said the real estate brokerage. You can be a real estate broker and be a real estate professional because of that. And if you own a single family house and you have someone else managing that, well, you don't materially participate. So that activity is still going to be passive, even though you're a real estate professional. So it's kind of a 2-part thing.
Again, it kind of goes to having a good tax advisor, right? And And I think the one mistake I made early on is I did have a CPA, but they just didn't really understand real estate. And talk about the importance of having a CPA on the one hand. So we're talking about now, doing taxes. And I want to separate discussion between someone who does taxes and someone who does tax advice, because in your world, for example, they're two separate things. They're related, but they can be two separate things. So let's talk about just being the CPA and the tax advisory, and someone who is very familiar with real estate and someone who is not, because some of the things we're talking about here, they'll go, oh, Michael and Tim and Garrett talked about this thing, and they take it back to the CPA and they're like, no, you can't do that. It's illegal. Like, oh no, well, that's bad advice. And I've heard that many times before. And it's because the CPA just does not have the background with real estate.
Yeah, definitely. I mean, so when you look at tax preparation in general, it's an unregulated industry. So anyone can do it. Michael, you could put out a shingle and say, I can prepare taxes. Exactly.
Let's do it.
And then you kind of climb up this wall. So you've got these unregulated, unlicensed individuals all the way up to CPAs. Well, CPAs have, number one, they have to go to college. They have to have a master's degree. Number two, they have to have continuing education every year. So every year I have to get 40 hours of continuing education. It's in what I choose, but it's in my industry. So I have to get it in tax. So I have to continually educate myself in the world of tax. So when you're looking at a tax preparer, you want someone that's licensed. You want someone that has that continuing education, because that forces them to continue to learn the ever-changing tax laws, because they just change. Every year we have new tax laws. They change every year. This forces us to have that understanding. But to that point, that 40 hours of education, just for me, has to be in tax. So I could take an hour of an IRA class. I could take nonprofit classes. I could take this class. I could take that classes. So a CPA might be more educated in tax law, but they might be a generalist in that they're only focusing on maintaining their understanding of individual taxation as it pertains to their client base. So when you start looking at people that focus in specific areas, I focus in real estate, large lion's share of my client base is in real estate, but also 90% of my client base is partnership based. So my exact focus is partnership taxation based on real estate tax law. So, I've kind of niched it into all of my education is focused in that one arena.
Why is it so hard to find the good real estate CPAs? Because I've gone through a lot where I've had to part ways with them, and it doesn't seem like there's a lot of transparency as to like, hey, hey, I'm the multifamily real estate CPA. Maybe talk a bit about why that is.
So number one, we're a proud bunch. So CPAs think that they can do anything. And number two, it's a function of revenue generation. So you've got, and I know I've talked to you about this before, Garrett, you've got the unregulated individuals that, you got John on the corner, let's say Michael, who's like, you know what, I'll do your tax return for $250. Well, my software cost is $250 per tax return. So there's no way I can do it. So what ends up happening is CPAs start grabbing and clawing at anything they can get, because they're competing with Michael, who's charging less than they can even charge software cost. And so now you've got this situation where everyone is saying, I can do everything. And really, it's the ones that you want to go to that actually say, this is what I focus in and this is all I do. Another thing is you look at a CPA firm, a lot of CPA firms, John will do tax prep for you. He'll do your bookkeeping for you. He'll do your payroll for you. And, oh yeah, you've got a defined benefit plan. I'll go ahead and do the tax return for that one. You want to look at firms that focus in one specific area. We do tax planning and tax consulting. It's all we do. We do have a separate firm, but all they do is accounting. And we don't commingle between the two, because we understand that there needs to be an expertise in what you're doing and a focus in that.
Well, let's talk about, so obviously focus on find a CPA that understands real estate tax law. I think it's really important, but let's talk about tax strategy, tax advice, that kind of stuff. How is that different from doing taxes, and why is it important?
Taxes are just a report card of how well you planned.
I'm talking about tax strategy, right? Tax
Right.
strategy. So a
Well,
tax
yeah.
strategist.
Yeah. So tax returns are just report cards. So if you're not doing any planning, your report card is gonna show that. And so tax planning is being proactive in that nature, because come December 31st, you can't really do anything to move that needle for the prior year. There's certain things, retirement plans, things of that nature. The Secure Act 2.2 allowed us to do some of that stuff. But really, come December 31st, everything that you could do to make that year more efficient is gone. And so that's the importance of tax strategy. Tax strategy is not only looking at where you were, but where you are and where you're headed. And so a lot of what we do and what we're looking at is to make sure that we're efficient throughout our life cycle. So, I always talk about, I want to utilize the lower tax brackets. I want to utilize the tax credits. A lot of people you'll hear, I want to pay no taxes. I make zero money. I offset all of my income. Well, you've just lost your 10%, your 12% bracket. And oh yeah, the first 100,000 of capital gains are taxed at 0%. So why would I ever want to offset those? Because next year, let's say you make $1 million. Next year, you're in 37% tax bracket. So why would I take $100,000 that's going to offset a zero tax bracket today, and then have you pay 100,000 or 37% on that 100,000 next year? So essentially, that's the part of tax strategy, is really looking at where you are, where you're headed, and making sure that we're utilizing the tax law that we have throughout that life cycle.
Where do you see people underutilize the tax law? So you come and you start working with, I don't know who you normally work with, a business owner, a high income earner, or real estate investor. You start working with them on a tax strategy perspective. What are some of the mistakes that you see people making, things they don't take advantage of, or whatever? Like, how do you make the biggest difference from a tax strategy perspective when you start working with people?
I mean, a lot of, like you talked about, there's a lot of, CPAs that don't do tax strategy. So there's a lot of stuff that's left on the table. There's also a lot of CPAs, like you said, aren't necessarily educated in an arena. So they're like, you can't do that. So a lot of times what we see is we always look backwards to see if there's any low hanging fruit. And a lot of times it's, they didn't segregation studies. They didn't utilize home office. They didn't pick up credits. They subjected income to tax that shouldn't have been taxed. So a lot of times we see, this net investment income tax. If it's an active trader business, it's not subject to it. We see a lot of times where people sell their businesses where the prior CPAs are utilizing, and subjecting it to it. So really what it comes down to is just looking at and talking to your advisor and making sure that you're meeting with your advisor before midnight on December 31st. That's the biggest.
Hopefully.
Yeah. Way before then. Yes.
Yeah.
But essentially, you need to be meeting on a whatever cadence, whether it's quarterly, semi-annually, a couple months before the end of the year, so that you can at least have that opportunity. Going back to what Garrett said, when you sell a property and you have depreciation recapture, well, how much is that depreciation recapture? Is it going to be ordinary income? How much money do I need to reinvest to offset that? So that's all important things that you need to do well before December 31st.
Yeah, I've had some bad experiences with big firms. I don't know, I've done a couple. I actually had a situation where I exited all of my real estate. I got bought out of it at a certain point, just my equity and all of it. And then I had a massive recapture, and my big firm somehow calculated it wrong. And I was short by about 200K come October. And so who you pick to do your taxes, I mean, really does matter. I mean, they were very, embarrassed by it and all that stuff. It didn't matter to me. I mean, I'd already found a home for those dollars. So it was, and I've heard multiple stories of that type of situation happening, or the big firms or somebody else doesn't look at the tax code a certain way. For example, they don't recognize GPs as having the ability to take any depreciation.
Mm-hmm.
They think it all should go to LPs. Why is there such a difference in opinion?
Again, I think it comes down to education. It comes down to expertise. It comes down to, number one, the first thing in partnership taxation, which is any of these deals that you're doing with multifamily syndications, all of that. the first thing that we are supposed to do is read the operating agreement. And I can tell you that I've had syndicators come to me and I look at what they're doing and I said, can I have your operating agreement? And they're like, wow, I've never been asked that. And my response is, well, then they shouldn't have prepared the tax return, because if they don't prepare the tax return based on the operating agreement, 704 specifically says we must follow the operating agreement. And if not present, then we must follow, 704. But essentially, it just comes down to education. Some people just don't understand operating agreements. I read 15 a week, 20 a week. So, I understand them, and I've taken a ton of education on partnership taxation to be able to understand and work with attorneys to draft them properly.
Well, that's what I'm saying. That sheds light on the fact that maybe one CPA should be involved in the drafting of the operating agreement when you buy a property.
100%. I mean, from day one, again, proactive. Got to be proactive, and you've got to be able to sit down and look at what there is. It depends on the state too. You're buying a property in Texas. How big is that property? Do we have the ability to potentially structure that deal to avoid Texas franchise tax when you sell it? Tennessee, same thing. Do we have the opportunity to structure a deal when we purchase it? Can we do a MIPA, membership interest purchase agreement, to offset some of that franchise tax? Do things of that nature. And then on top of that, what's the intent of the deal? What do you want the deal to look like? And let's make sure that the operating agreement is in line with that. So yeah, I strongly advise that you bring in your CPA in any deal you're doing, or any business you're starting. It doesn't matter what it is. If you don't have that advice in the front end, it could be a disaster on the back end.
That's funny. You mentioned these franchise taxes in those areas. I think we got bit by that as well. Like, oh, well, shoot, we should have had a CPA involved when we bought that deal 5 years ago. Now we owe a bunch of tax that probably was avoidable. Yep. So that's good advice. Let's talk about some changing legislation. You talked about getting continued education. What are some of the things that you see have changed recently, or about to change, maybe even with the election? Like, what's on the radar?
I mean, it's been a pretty quiet year. The only thing that was kind of on the horizon that passed the House was a tax bill that got held up in Senate, and it effectively got voted down August 1st. That tax bill was to bring bonus depreciation back to 100%. It was to bring our R&D back to where it was pre-2017, and it was to increase the ability to take business interest deductions. I don't see a lot happening in the next 6 months, 2025 potentially, but right now I think we're kind of just in this holding pattern. So a lot of what we're looking at is what was done in the prior year. The IRA, or Inflation Reduction Act, brought in a ton of energy credits, things of that nature. So do we have the opportunity to use that, especially in a business? We potentially have the ability with solar to take a credit and also deduct that asset. So we can kind of double dip on things of that nature. So we're exploring a lot of those avenues when it comes to large businesses, multifamily. You own a business that you own the building on. Can we add solar to it? Can we take those deductions?
What do you think will happen if we get a Republican president?
I don't know.
Oh, come on, speculate, Tim.
See, the problem, okay, so the issue is this tax bill has been, so bonus depreciation, let's just go with bonus depreciation. Bonus depreciation was enacted in 2001 by George Bush. It was to spur U.S. manufacturing and the economy. It went through its iteration, went through the Obama administration. It was brought back up. It started to phase out. Trump administration brought back up, phasing out. I mean, it's bipartisan. It passed the House almost, unanimously bipartisan. So I think there's an opportunity. I don't know what ultimately is going to happen, because there's so many different nuances in whether or not it's a Republican House and Senate or a Republican president. If it's a lame duck scenario, we could find ourselves in the same situation where everything's just kind of phasing out.
All right. That's cool. So talk a little bit about how people can find out more about you and Provision and connect with you.
Yeah, definitely. You can go to provisionwealth.com is our website, have a lot of information on there. There's a contact us button up in the top right-hand corner. you can definitely contact us. We will reach out to you, schedule an appointment, and sit down and talk to you about your taxes. Talk to you about where you are, whether or not we can help you. One of our number one kind of core ethics is that we only want to work with people that we can help. We want to be a return on investment and not an expense. So don't be deterred if we say, hey, we can't help you right now. It might just be we don't see that there's the value in it. I don't want to charge people in that regard. You can also email us at contact@provisionwealth.com. And then same thing, it starts that dialogue, and we'll reach out to you and have a discussion on how we might be able to work together.
Tim's been great shining light on taxes and all the benefits we get from real estate. So thanks so much for being on the show today.
Yeah, definitely. Anytime.